This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Rick Rule joining us today from San Francisco. Rick is Chairman and Chief Executive Officer of Sprott U.S. Holdings, Inc. Welcome, Rick.
Thank you, Gordon.
Pleasure to have you with us.
My pleasure. Thank you very much.
It's been, well, I was just thinking, you're in San Diego here this morning, correct?
That's correct.
And I'm thinking you're probably one of the most recognized people in the world in natural resources, and I'm thinking of this water shortage in California. Are you having an opportunity there in any way?
Well, in a sense, it's reinforced to me. I'm looking out the window, and it's absolutely beautiful, but it's much more beautiful than a spring day hopefully ought to be. We ought to be having some rain, and as you know, we've had none. Are there opportunities? Of course, and we can discuss those in the show. Every crisis makes opportunity, and this is shaping up to be a full-blown crisis here in California.
Yeah, that's what my understanding is. And the irony is I'm in Boston right now, and I'm looking out the window over here, and we still have snowbanks. So we got more water and snow than we've ever seen. I've been here 25 years, and I've never seen anything like it. Set all sorts of records. But anyway, Rick, let's get into the show here. A lot of our listeners are certainly familiar with you and your work, but some aren't. Could you please give them just a brief outline of your background, things you're involved with?
Yeah.
Sprott.
I run the non-Canadian business of Sprott Inc., which is a Canadian domiciled and listed investment manager focused primarily on natural resources and precious metals, but in fact a money manager in any area where we think we can add value for high net worth individual investors. We have a variety of investment products, but as I say, in terms of assets under administration or assets under management, in excess of 75% are natural resource related. I myself have been involved in the natural resource investment business, I'm embarrassed to say, since the mid-1970s. I've done one thing the whole time. I guess I'm a fairly dull guy, but the good news about that is after 40 years, I've begun to learn some lessons which are practical and hopefully in the course of this call transferable.
Yeah, I know the feeling. I've been at it for 40 years myself, and I do remember the early 70s quite well. Rick, this is part of our series on financial repression, and I'd like you, if you could, to define in your own words what financial repression is, what it means to you, and your general views on it.
Well, the manifestation, let's begin with the definition, I suppose. I guess any financial control or trickery imposed on individuals by the state would be my definition of financial repression. There is certainly financial trickery imposed on us by large financial institutions, but they do that utilizing the state or in conjunction with the state. The practical manifestations of financial repression are all around us. I would suggest that a large part of the mandate of the Securities and Exchange Commission, as an example, is to affect barriers to entry to smaller participants in securities business. But the most egregious forms of financial repression are probably in the first instance tax, which many people regard as slavery. I don't. I regard it as extortion. And of course, the manipulation of interest rates and the manipulation of the currency. You know, Gordon, when you and I were younger men, much younger men, in fact, if we would go to a savings institution and go to make a deposit, they would often give us a bonus, something like a toaster or some consumer good, as an expression of their gratitude for depositing money. It's getting to the point now where you go to a financial institution, you have to give them a toaster to take your money. The interest rates payable to savers relative to the real rate of depreciation of the purchasing power of, pick one, the dollar, the euro, the yen, are despicable. As recently as October of last year, I had the pleasure of listening to Alan Greenspan who was ironically, despite the fact that he's an avowed libertarian, the architect of a lot of this financial repression. And he said something very stark to the audience. He said that a sound currency is not consistent with a representative democracy, that a sound currency benefits the productive classes, the savers. And in a representative democracy, most of the people are spenders. Low interest rate and a depreciating currency aids the spenders, the borrowers. It doesn't aid the savers. And so in that context, financial repression is understandable and probably, I'm afraid, inevitable.
Well, we're certainly seeing it within all the developed countries, depending how you define it. But generally, we see it as a combination of negative real interest rates. And by the way, we now see negative nominal rates in bonds and right across, specifically in Europe, but in a combination with a policy of inflation, which between the two really hurts pensioners, savers, takes money out of their pocket in terms of spending power. But it involves other kinds of things, and that is regulatories that force people into a higher risks to kind of take advantage or to make some kind of yield. Do you agree with those observations?
In every regard, everything that you have said, I agree with completely.
So where do you see, with these policies that implemented, where do you see it leading to? Where does it end, or are this a permanent state of affairs?
Well, with the caveat that I've made one mistake repeatedly in my career, which is to confuse two English language words, one inevitable and the other imminent.
I can see your trading background showing.
I will tell you that from my point of view, ignoring the basic tenets of economics and mathematics doesn't work over time. I have also learned that over time is a very long period of time. We appear to be at a place in history and at a place in the economy where there is extraordinary faith in the big thinkers of the world, the Merkels, the Obamas, the Greenspans, the Yellens. And it is partly this faith that is allowing them to keep interest rates this low. It is a belief, I think, that the big thinkers of the world stick-handled, in Canadian parlance, society's response to the global financial crisis of 2008, and by managing the levers of the economy, managed to save us from ourselves. I would, of course, disagree with that diagnosis, but nobody cares very much what I think. So I certainly believe that savers will tire of buying financial instruments that have no real yield. If you think about the value proposition as an example offered up by the bellwether savings instrument worldwide, which is the U.S. 10-year Treasury, the last time I looked, it was yielding about 1.8%. So what that means is that the Fed absolutely positively guarantees you 1.8% a year for 10 years. The difficulty that I have with that is that even at their ascribed CPI inflation rate, what they're promising you is about 20 basis points a year in real yield. Jim Grant famously characterized that as return-free risk, which I think is a phrase that your listeners ought to think about. Think about how attractive return-free risk is. But I think the situation gets worse than that, Gordon, because the people who compile the CPI don't shop where you shop or where I shop or where your readers shop. The idea that the basket of goods and services that comprise what you and I consume in the course of our day-to-day living doesn't go up in price by 1.8%. It goes up in price by more than that. It's worthy to note, and this is my simplest objection with the CPI and hence the 10-year rate, that the cost of living index compiled by the U.S. government doesn't include tax. Now, I suspect if they didn't charge me the tax, I would be polite enough not to complain so vociferously about the index. But the probability that they would accord me that privilege in return for my not complaining is very, very, very low. The point of all this was illustrated very well as I drove to work today. I drove past a Motel 6. You will remember, Gordon, that Motel 6 was named because a room there cost, pardon me, $6 a night. This morning, the sign at Motel 6 said Motel 6, $69.95. Now, there can only be two explanations for this. One, over the course of 30 years, the utility of a room at Motel 6 could have increased 11-fold. I think that's difficult because the rooms are the same size, and I suspect they haven't changed the sheets. The other alternative could be that the denominator, the purchasing power of the US dollar, has declined by 95% in 30 years. I will leave it to your listeners to decide which of those two explanations makes the most sense to them. If you agree with me that it's explanation B, the deterioration of the purchasing power of the dollar, that puts the investment proposition of the U.S. 10-year Treasury clearly in your crosshairs, and it's not very attractive.
There's no question. The couple points there in terms of the dollar and inflation rates. You talk to anybody. Obviously, people have strong feelings on inflation, but they'll say, what are you including in that? And their basket of goods is not just the food and some of the elements. It's what's their student loans for their kids, what it's gobbling up. It's what they're paying for medical coverage that's being gobbled up. It's what they're paying for services, for maintenance and other people to do professional work for them. Those are the things that are going up dramatically, but they don't count in the basket. So they feel it. But the point of that really is that real disposable income and vis-a-vis demand in a 70% consumption economy we have in the United States seems to be, I will use the word stalled or being compressed. And I'm looking around the world, and the United States was the engine for growth economically, and I'm seeing right from the commodities on through, there seems to be a demand problem. Is that a fair observation, or a growing demand problem?
Is it ever? I live in the natural resources business.
You would see it firsthand, because that's the first thing that's hit. When people see that demand is slowing, because in my opinion, quantitative easing was nothing more than bringing demand forward, which it did, having money to spend. Supply goes up to match demand, but we're working then at elevated levels. And the moment demand slows, people cut back. They are prepared. First thing that goes, futures contracts on your commodities.
I think you're absolutely right. If you look at things like the median age of consumer durables in the United States, refrigerators, freezers, stoves, things like that, or the median age of the automobile fleet in the United States, they're at all-time record highs. That is, that the inventory is the oldest it's been since the statistics have been measured. Now, part of that is due to the fact that the quality of the goods being manufactured today is substantially higher than it was 20 years ago. But most of it goes to affordability. People are postponing their purchases of cars and consumer durables because they can't afford to upgrade.
Correct.
Real workers' wages in the United States have been stalled for a very long time. Now, people could argue that part of that has to do with an inefficient education system in the United States. Part of it has to do with the perverse incentives that are available to people not to work, to rely on other people. But I think a lot of it has to do with the fact that the society, as you suggest, and the economy have been manipulated enough that there hasn't been the form of long-term investment in productive assets that would allow the employment of technology and real workers' wages to rise.
We've never seen it. The lack of capital investment and investment into productive assets like this before, it's almost completely gone. And I say that and I've cited this a couple times, last quarter, the S&P 500, 90% of all profits went back into dividends and buybacks. Where's the investment of assets?
Well, I think that's a very good point, and I think there's a couple parts to that discussion. The first is that if you aren't seeing underlying demand, in other words, you aren't seeing top-line sales growth in your business, why would you invest in productive capacity if you have sufficient productive capacity? The second thing is that the U.S. tax code is anti-growth. If you look at allegedly more statist, allegedly more socialist countries, Sweden is a classic example. The depreciation schedules that you say in places like Sweden and Germany and France are much more investor-friendly than they are in the United States. In certain circumstances in the United States, we have a 30-year depreciation schedule for heavy capital goods like tilt-up concrete buildings, whereas in the so-called socialist states like Sweden, you expense them in year one. Now think about where you would rather make a capital investment, where you can take it off your tax in the current year or whether you spread it over 30 years. I mean, this is fairly silly stuff.
It isn't when you're running a company. This has caused a lot of leverage and opportunity. Rick, if we're right with this slowing demand and possibly staying with us for a protracted period of time, what does this mean to the natural resources overall that are the basis for all of the raw materials for the productive capacity?
Raw materials prices rise for one of two reasons: demand creation or supply destruction. What you learn in natural resource-based businesses is that markets work. They're extremely messy, and there are winners and there are losers, and the winners like it and the losers hate it. A wonderful example has been the oil price. We had 8 years of very strong oil prices. And what you would expect to happen happened. The high prices led to technological innovation and billions of dollars of investment. And the consequence of that was that production increased. At the same time, high real energy prices led people to develop processes to use less energy in their day-to-day life. So demand fell and production increased. What do you expect the result of that would be? Of course, the price crashed. Now, you correct this by one of two things. Either the lower prices stimulate demand, which can happen in the fairly short term, but doesn't seem to be happening now, or you destroy productive capacity. Those are your two choices. And so really, I feel as a natural resource investor, like the guy in the old Purolator oil filter commercial. I could look at my customer, my resource customer, you, and say, you can pay me now or you can pay me later. If you remember that commercial, it was a $6 or $7 oil filter as opposed to a $2,500 blown engine. And that's precisely the way that natural resources work. Because if you destroy productive capacity, it takes a very long time to restore that productive capacity. So when demand increases past marginal supply, the supply response from the industry is very delayed. And as an example, if the clearing price for producing oil, where the industry earned its cost of capital, might be $75, if you destroy enough productive capacity, when the price goes up, the market clearing price in the near term becomes 110 or 125 because of the long-term capital-intensive nature of replacing the supply capability that you destroyed. So I think as an example in the oil and gas business, if we can get ourselves to $75 a barrel in 2 years, we can moderate the increase in energy price. But if we don't do that, ironically, 5 years from now, we'll be looking at 125 or 135 because it takes a very, very long time for new productive capacity to meet supply constraints or increased demand. The nature of the business, because when I say the business, I mean natural resource businesses, the nature is that they're capital intensive and they're cyclical. And that means on the downside that they violate, if you will, normal principles. When you are oversupplied in resources, people don't worry about making profits on a unit of production basis. They look at covering their cash cost because they have so much stranded capital. On the upside, if you've destroyed capacity, you can't just turn on an oil well. You've got to drill it, you've got to connect it, you've got to complete it. And of course, the problem is worse with an iron mine or a copper mine. So what you learn in terms of being an investor in natural resources is that oddly, you have to invest in times when the industries are literally in liquidation, when they get paid less for a unit of production than it costs them to produce it on a total cost basis. When you have that situation, there's only two choices. The commodity price can rise or the commodity can become unavailable. And the idea that we're going to have a world for the next 30 years where there's no copper, i.e. there's no electricity, or where there's no energy, is silly. It truly is silly. The converse of that is in natural resource businesses when everybody is making very, very, very large unit sorry about this phone, is making very, very large unit profits, you have to have the good sense to sell because good times don't last in the same sense that bad times don't last, and perversely for the same reason.
The supply and demand balance, let's flip it to precious metals and talk about gold because it's now running at the dollar cost, the cash cost to produce it, thereabouts, generally.
Gold is odd in that you have to sort of segregate the metal from the equities. Remember that in terms of supply and demand, almost all the gold that's ever been mined still constitutes supply. New mine supply might be 1.5% of total supply. Mm-hmm. So in the context of precious metals, gold and silver, although silver less so because of its industrial applications, you have to divorce yourself from new mine supply and demand. In this particular case, with regards to gold, I think what you have to look at is the utility of competing investment vehicles. Gold has traditionally been one of the few mediums of exchange or currencies or money that wasn't a promise to pay, but constituted payment in and of itself. So the utility of gold traditionally has been a mechanism for settling transactions for other things in an atmosphere with low social trust, or has been a store of liquid wealth that constituted payment. Gold has done well during periods of time when people were nervous about the underlying sociology, politics, and economics of the societies that they've inhabited. The gold price is doing poorly right now because of very, very, very strong faith in the existing financial system that we exist in. Misplaced faith, by the way, from my point of view, but obviously given the gold price and the yield on the 10-year Treasury, I'm way, way, way out of step with the average American. It's interesting to me, Gordon, that if you look back to 2011 and you look at the gold narrative when gold was at $1,900 an ounce, the narrative then went something like the on-balance sheet liabilities of the United States are $14 trillion. And the off-balance sheet liabilities, by the way, people like you and me, people approaching retirement age, that's the off-balance sheet liabilities.
I'm now a liability.
That's right. We're $50 trillion. And the supposition was that given private savings rates in the United States, that those liabilities were unserviceable. That was, 6 years ago. Fast forward to today, and the on-balance sheet liabilities have increased from $14 trillion to $18 trillion. And the off-balance sheet liabilities, at least according to the Congressional Budget Office, are at about $80 trillion. And so the supposition today is that $18 trillion is more serviceable than $14 trillion was, and $80 trillion is more serviceable than $50 trillion was. I am not an economist. I'm a credit analyst, but I have a very difficult time with the arithmetic behind that supposition. The other interesting thing with regards to gold, and you're going to be sorry you asked me this question because I have a very long-winded answer, but the negative real interest rates that you describe on sovereign obligations and the low nominal interest rates available on corporate obligations, I think is very bullish for gold. For related reasons. First of all, the competition offered up by the U.S. 10-year Treasury, which we have described as return-free risk, must be low. Secondly, 7 years ago or so, when the 10-year Treasury offered 6%, if you owned gold as opposed to 6-year Treasuries, in effect, you were paying 6% rent to own your gold by way of avoided yield. 6% might have been onerous rent, but 1.8% is not very onerous rent, particularly given the inherent risk now in owning the 10-year Treasury.
Mm-hmm. Well, I'd be amiss if I didn't ask you, in terms of gold and silver outlook, what do you see happening in 2015? Because I know a lot of our listeners are particularly interested.
I don't know what's going to happen in the near term. And sadly, because I know people have time frames that are unrealistically short, what will move gold and silver and platinum and palladium are first and foremost a reduction in confidence in the U.S. dollar and the U.S. 10-year Treasury. It's important for your listeners to know that gold doesn't have to win the war. It needs to lose the war less badly. In truth, for those listeners that you have outside the United States, and I know there are many, gold has performed admirably in the last 14 months in every currency that you can name, save one major one, the U.S. dollar. Gold is already in a bull market. And in that regard, the gold market reminds me very much of 2001, 2002, where gold was rising in all currencies except the US dollar, and the US dollar was trouncing everything else. I guess a 25% nominal rise in the US dollar, which is what we've seen relative to a basket of currencies in the last 12 months, is ample reason for trend followers to be long the dollar relative to gold. I would just point to people who look at the immediate past with regards to markets in terms of making all their decision as to what's going to happen in the future, to think about the arithmetic, not quantum physics, just the arithmetic that we've talked about in this call. Negative real yields, the deficit, the inability of the United States to solve social problems outside of Washington, which seems to exacerbate rather than solve them, and think about whether or not they believe that a 1.8% nominal yield is fair compensation in a currency that, from my point of view, has many more headwinds than is taken into account. If people agree with that supposition, they will buy gold for their own account, and they will pray, assuming that they're religious, that the price of gold doesn't go up, because the whole set of circumstances that makes gold go up, unfortunately, is not very conducive to the rest of your portfolio. I'm in the odd position myself of being a large shareholder and working for a company that will profit in the event that a gold price goes up. I'm the one that probably has the least need of anybody on the call to own physical gold. But I own it anyway. I own it the same way that I own life insurance or auto insurance or house insurance. By the way, I'm not dying to get paid on any of my policies. And what gold is about is maybe not the death, but maybe the disability of currency, the US dollar. I'd love not to see it, but I sleep nights and stay calm having that insurance policy. And that's the way that I would encourage your listeners to view gold.
Very, very, very valid. Rick, any key messages you'd like to leave with our listeners?
Yeah,
from your 40 years of experience in markets?
Absolutely. Markets work. If you are going to succeed in markets over time, you're going to have to be a contrarian. If you're not a contrarian, you're going to be a victim. That's the way things work. When it looks in the market like things couldn't possibly get any better, that's always the Wall Street promise. Well, what happens if something can't get better? It gets worse. There's no such thing as stasis. If it looks like an industry is in complete crisis, if it looks like things couldn't possibly get any worse, you don't avoid it, you go in. That's when things are going to get better. Buffett famously said that he made his fortune very simply by being brave when others were afraid and by being afraid when other people are brave. If, as an example, you look at California and you look at the fact that almost certainly in the next 2 years, if you're one of these West Los Angeles Cadillac commies, that $150,000 worth of West LA landscaping you have is going to turn into wilted lettuce. That's going to happen. So what do you do about it? Well, I would suggest, as an example, making water-related investments. If you look at the catastrophe that is coming to the smaller end of the over-leveraged oil equities, what do you do about that? Well, you try and figure out when the sentiment with regards to energy equities is at its worst, and then you buy straw hats at winter. You become brave when other people are afraid. Similarly, if you're looking at sectors where everybody is euphoric, everybody is brave, think what the probability is that you're going to be able to buy bargains at that point in time. Everybody, sadly, Gordon, wants to be a contrarian when it's popular. And there's a problem with that thesis. That's just not the way markets work.
It's such astute feedback or advice, but very few pay attention to it. It's like I'm a sailor, and when everybody gets on the same side of the boat tends to tip. But the reason they're all on the same time of the boat because there's something interesting over there that they all want. And the answer is that's the time you should be on the other side of the boat. But it tips real fast. That's the other thing I learned. So maybe a bad analogy, but it's the best one I have.
Very graphic description.
Rick, we got a break now. We're up against our hard line. A great conversation. Really enjoyed having you. We'll have to have you back again because always lots to talk about.
I look forward to it. Thank you for giving me access to your audience. I appreciate it.
Thank you very much. Talk to you again.
This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.